I'm Anthony Valeri, Senior Vice President and Fixed Income Strategist at LPL Financial Research. After a difficult month of May, municipal bond investors are now faced with what has historically been a difficult start to June. On a positive note, the start of summer in late June typically ushers in one of the more attractive times of the year to own municipal bonds. Buying demand from maturing bond proceeds combined with a slowdown in new issuance normally creates a more favorable supply-demand dynamic that typically benefits the municipal bond market from late June through the end of August. June and July represent the two heaviest months in terms of maturing bonds for the municipal bond market, and reinvestment demand can be a powerful force. Municipalities tend to issue new debt to replace maturing debt, leading to an increase in issuance, and the first 2 weeks of June can witness weakness as investors assess the market reception and impact of new bond issuance before reinvesting those maturing bond proceeds. To put the seasonal pattern in perspective, July has been the best month for municipal bond investors, with an average 1.0% return during the month, according to Barclays Municipal Bond Index data going back to 1990. Furthermore, July has generated positive performance on all but 2 occasions over that time period. August is not far behind July, with an average 0.8% total return and posted positive returns in all but 5 years. Not quite as impressive as July, but a good batting average nonetheless. Seasonal patterns don't always come to fruition, however. May is typically one of the strongest months for municipal bond performance, but May 2013 certainly disappointed. Municipal bond performance in May was the weakest since December 2012, which witnessed a surge in new bond supply and in turn is the weakest since late 2010, when Meredith Whitney-related credit quality fears sparked a violent municipal bond sell-off. Such bouts of weakness are rare, and May 2013 selling was in large part due to the taxable bond market, which was weak in response to fears over the Federal Reserve reducing the amount of bond purchases, known as tapering. We believe bond market fears over Fed QE tapering may be overdone and pushed yields too far too quickly. The Fed is only changing the amount of monthly bond purchases at this point, and its commitment to refrain from raising interest rates until the unemployment rate falls to 6.5%, a period of time which may extend until mid-2015, remains intact, and market expectations appear to have corrected with the consensus of primary dealers, those firms required to trade treasuries with the Federal Reserve, shifting to expect quantitative easing tapering to begin in September 2013, up from an initial expectation of December 2013. In other words, the rise in yields may have already priced in the impact of uncertainty from the Fed. The recent rise in yields also, coupled with any additional increase that may have come from typical June challenges, may result in an opportunity for muni bond investors. There are still risks, and those include no guarantee that seasonal strength may manifest itself this summer, and a still heavy amount of bonds lingering in the secondary market, which also played a role in pressuring prices lower recently. However, average AAA-rated municipal bond yields are already at their highest levels since April 2012, according to Municipal Market Advisor's data. A more reliable, favorable seasonal period is just around the corner. Municipal to Treasury yield ratios are back over 100%, and signs that selling may have become indiscriminate as yields on higher creditworthy issuers converge with those of less creditworthy issuers offsets these risks in our view and helps buffer the downside for investors. We believe high-quality intermediate to longer-term maturity bonds suffered the brunt of recent weakness, were inordinately punished, and in our view may stand to benefit the most from seasonal strength. Both segments possess more attractive valuations relative to short-term bonds and would benefit more from any subsequent decline in yields. Keep in mind that such opportunities should be balanced against what is still a low return environment for bonds. But in a low yield world, such pullbacks will likely be few and can provide potential opportunity for investors. Thank you for listening. I'm Anthony Valeri.